If you've ever looked at your profit and loss statement, felt good about the number at the bottom, and then wondered why your bank account tells a very different story, then this episode is for you. Welcome, or hopefully welcome back to The Reluctant Entrepreneur. This is the podcast where we explore the real stories behind starting and running a business, and where practical experience matters more than theory. Today's guest is Jen Fizer, CEO of MKB Co, a fractional CFO bookkeeping firm that works primarily with blue-collar businesses while also supporting other companies across a wide range of industries. Jen helps business owners understand what their numbers are actually telling them, especially when profit on paper doesn't translate into cash in the bank. This episode is broken into two parts. In the first segment, we'll talk about Jen's entrepreneurial journey and how she found herself building a business focused on financial clarity and forward-looking decision-making. In the second segment, we'll dive into her expertise around cash flow, clean books, common bookkeeping mistakes, and how business owners can use accurate financial data to make smarter and more confident decisions. My conversation with Jen Fizer begins right now. Stick around. Hey, Jen, welcome to the program. I'm so glad you're here.
Hi. Yeah, thank you for having me.
You're very welcome. I should have met you 33 years ago when I started my business, because just based on what I've learned from you, I could have learned a lot. I could have avoided a lot of painful years and just having that knowledge up front. But here we are, 33 years later.
Well, you know, I had to go through a lot of these things too. So it was not I did not come into this world knowing all of the financial knowledge that I do know now.
You were not a naturally born financial wizard. It still took time for you.
I apparently am a very hard learner. Is that the right word? Like, I have to learn some things myself before I can
I'm
really
the
learn
same
that
way.
lesson.
Yeah, I'm the same way. I experience certain situations, make a mistake, maybe I kind of get a clue. I should go left instead of right. I'm always going right. Maybe I should avoid going right. Maybe I should go left. And it's not till maybe several years later, all of a sudden I'll go, oh yeah, I should have gone left. I knew it kind of ahead of time. It was exposed to me. The concept of it was exposed to me, but I just went, nah, or I was too scared to do it or whatever.
Yeah.
But once I did it, I realized, no, I've been shown this before. And it just took a few years to sink in, right? But
I'm trying to fix that. In the last couple of years, I'm like, I need to stop doing these things myself and learn from other people's mistakes and not do things the hard way every time.
Yeah, I wrote a book last year called The Reluctant Entrepreneur that the show is named after. And I tell my friends, it's not a how-to book. It's exactly a how not to book. Here's every mistake I ever made and what I've taken away from that experience and learned from it, hopefully. So if you just don't do what I did the first 10 years, maybe you'll become successful faster, or maybe you'll just become successful. But it's a journey. It's just a journey. I don't think there's really a destination, right? You're just constantly learning and evolving and revolutionizing yourself. Let's go down memory lane a little bit, Jen. You're the CEO of MKB Co. Now, you actually say Co, not Company, right?
Yep, MKB Co.
I like it. So you're the CEO of MKB Co. Today, but take us back to the beginning. What was your path into entrepreneurship? What made you decide to sign the front of the check instead of the back of the check?
Oh, gosh.
And was this something that you've always planned to do, or you just, set of circumstances, you ended up there? Or walk me through that journey.
Sure. So if we go back, I don't know, let's say 10 plus 15 years probably. So I never had the entrepreneurial bug. I didn't think I would like doing sales. I grew up being told by my parents that you want to have a career, safety, work for the same company for your entire life, have a nice retirement, and move on.
That's definitely a
And,
generational thing there. My
and both
parents
of
were
my
the same
parents
way.
did that. Yeah.
Yeah.
My mom worked for the same company for 40 years. My dad worked like 30 years at one, and then he retired and then went and worked 10 years at another. I mean, they were definitely the definition of not job hopping, just stay
Yeah.
somewhere. They both got pensions, right? So it was very like, of that time, made perfect sense for what they did. And they had just kind of instilled to me like sales for some reason was like slimy car salesman. You didn't want to be in sales. You didn't want to have to push anything. Go be an accountant because that's a very safe, not easy, but like very safe job. Everybody needs accountants, that kind of
Sure.
thing. And so let me just say it. When I graduated from college, never did I think I would be a business owner. That was not even on my radar. I did not think it would be something I would enjoy. And then I graduated college in December of 2007. And so I went into the job market in a recession, essentially.
Yeah.
And
A
my
great
jobs
recession.
my
As it's known now.
jobs for the first 4 or 5 years of they sucked. I made no money. It was just not a good time to graduate from college, really. But I worked at this one job, and on one of my first days there, I'm telling you a really long backstory on why I'm an entrepreneur.
That's great.
On one of the first days, I was training with this guy, and I was a utility arborist. So I worked for the power company. I identified the trees that needed to be trimmed. But that day that we were training, you spend a lot of time in your vehicle because you're just driving from one spot to the next. And he was like, I love listening to Dave Ramsey during the day. He's like, it's just my money thing. And I'd never even heard of Dave Ramsey. And so I started listening to him. I only worked with this guy for like 3 days, but he like set my routine for me. And so Dave Ramsey was always talking about the best way that you can increase your income is to own a business. And so that was like what started getting my wheels turning on, okay, that's what I want to do. I also don't really like working for other people. So it kind of like fed into that. Like, I like to be the boss. And so,
Well, entrepreneurial people, whether you intended to or not, certainly you were entrepreneurial, if not an entrepreneur back then.
yeah, I
We
just
make
did not
terrible
know.
employees. We are,
Yeah, absolutely.
and we make terrible bosses. We're for the same reasons, right? We just draw outside the lines, and the rules don't apply to us, and all of that. But
Yep.
yeah,
So as I started listening to that, like things started to click, and I'm like, oh yeah, like I actually would like to own my own company. I would like to be the one that's in charge of how much I make and what I do every day and all of those things. So that was kind of what put the bug in my ear. And then, I spent probably, I don't know, 5-10 years just kind of not really knowing what that meant, though. Like I didn't have a business idea. I lacked the confidence to really like pull the trigger on anything specifically. And I didn't really have like support, anybody telling me it was possible that I could do it. So it was all in my head. Like I was the one that I was also married. I had to like make sure that, our family didn't fall apart if I went and started a business. So all of those things. But then in October of 2019, an opportunity arose where there was a coffee shop for sale in the town that I lived in. And they wanted basically no money for it, really. It was very cheap and it was failing. But I was like, I could see all of the things that needed to be fixed immediately. Like I heard about it. I went and looked at, what they were doing. I went into the store and I was like, I can fix this place. So I bought it like
wow.
3 weeks later. And so that was my first real dive into entrepreneurship. I like sold Beachbody and like some things like that before, but
Did
never
you
really.
turn the coffee shop around? Was there a
Yes.
successful
I owned
exit,
it
or do you still own it?
Nope. So I owned it for 5 years. I sold it in July of 2024. And the funny thing is, though, about that story is that like that was my first real business, I will call it. But that whole time that I owned that coffee shop, I still in the back of my mind was like, what am I going to do with my life? Like, what am I actually going to do for my real business? Even though that was
Right.
a real business, I was like,
So you knew at the
I
moment
wanted
that
something
was
new.
a temporary,
Yeah. I was
turnaround
like,
because you knew you could.
exactly.
Yeah.
And so when I sold the coffee shop, my friend Mills, she owned Mills Knows Bills, which is MKB's former name. And I started working with her. She did fractional CFO work. And so I just asked her if she needed an extra CFO. That's what I did in my after I was the arborist, I became a CFO. That's the natural
Yeah.
progression there.
Doesn't everyone?
Exactly. And so I started working with her, took on some clients, and then earlier this year, back in I think March of 2025, she asked me if I wanted to buy the business, and here we are. So long
Wow.
story, not short, how
No,
I
that's an
got here
interesting
today.
journey. I think in my case, it certainly applied to me, and it sounds like yours too. I liken my journey into entrepreneurship as a ball and a pinball machine, just
Mm-hmm.
bouncing off the bumpers and the flippers and the ejection holes, whatever makes up a pinball machine, with seemingly no planned trajectory. Right
Yeah.
now, obviously, I think looking back now, there was a planned trajectory. Call it fate or destiny or whatever the case may be, but or we manifested it or something deep inside, not even realizing it. But in the moment, it does seem very random, right?
Yeah.
To go to college and then become an arborist, and then from an arborist, coffee shop owner, CFO, right? Those are the. I can just see
Yes.
the ball bouncing off all the bumpers in the
Like my
pinball
resume
machine.
is a mess. Like you would be like, what is this girl doing?
Yeah,
But when I went to buy the coffee shop, that was when all of those like odd jobs that I'd had for the previous 10 years, I was like, oh, they all make sense now. I was building like this toolbox of it because I worked in recruiting. I was an admin assistant. I was the CFO of a company. That wasn't my first title at that company, but I worked myself up to that. I was in retail, like all of those things that were like, this doesn't make sense. This is not a normal path towards anything. Like, what kind of job could you actually get? I was just building all of these skills that, like, oh, business owner is actually the skill that I was building. And
yeah.
I just needed all of those things to kind of come together.
It's amazing how it works out that way. What problem were you seeing in small business and blue collar businesses specifically that made you realize that there was a real need for a fractional CFO type support system?
Mm-hmm. So I think a lot of businesses, as like when it's just one person, right? Like somebody wants to be a plumber. Um, it's fairly easy to figure out if you're being profitable or not because you are one person, your bills are coming in and out of your bank account. You're not really having to plan for the future. It's like whatever's left in the bank is probably profit. So you can kind of just take that as your salary. But then as people start to add to that business, you add another plumber, you add more vehicles, you add an admin assistant. Suddenly it becomes way more complicated to figure out if you're even making money or not. Are you pricing things correctly? The complications in that just 10x pretty much overnight, it feels like.
Yeah.
And somebody can go from being very profitable to suddenly like not having enough money to pay their bills at the end of the month. And that happens very quickly. And it's kind of counterintuitive because you feel like, oh, I'm bringing in so much more money that should translate to more profit. And as we kind of talked about it a little bit before we even came on this podcast, like that's not actually what happens, right? Like
No, it's quite the opposite. I've lived situations in growing my business where we were profitable, but almost would go out of business because we had no cash.
yeah.
And I've also lived the other way where cash flow was great. We were bringing in cash left and right. It just wasn't profitable. But
Mm-hmm.
it didn't show itself because it was like a Ponzi scheme. It was like a Bernie Madoff Ponzi scheme where we just kept getting suckers to invest money. In that case, it was not suckers our customers. It was we were the suckers. We were bringing in all this cash, thinking cash is coming in every day in excess of what we're spending. So therefore, we must be profitable. And it turned out we were just getting more sales faster than we were properly scaling the business to handle those sales. So, the fact that you get a $50,000 deposit on an order and you don't have any expenses tied to it that day does not mean that $50,000 is ready to, go to Cancun with or something. It's it has to be allocated. The expenses associated with that have to be allocated. And that took a long time for me to really realize that. And to me, income statements were, I just looked at the top and the bottom. I looked at revenue, net, and I thought everything ended with net. And then someone introduced me to the balance sheet. And the balance sheet's initials are BS, and I looked at it as, this is BS. This is just a giant buzzkill. I'm not interested in the balance sheet at all. I just show me the top and show me like a gross. I'm fine with that. But anyway, I'm your perfect customer. I would have been your perfect customer. But and sorry, I interrupted you.
To your point, like the profit and loss statement, I get usually two like surprises from people whenever we pull up a profit and loss statement, possibly for the first time. And it'll usually be like December, right? Or January when it's too late, or we'll pull this up and it might show that they had $100,000 in profit and they start to panic because it's like, well, where is that money? That's not the money that's in my bank account. Where is that money? And I'm like, well, here's the thing. On your profit and loss statement, things like debt payments. So if you have any equipment or vehicles, anything that's got a loan on it, like those are not on your profit and loss statement. So that's money that's just poof, gone. Like out of that profit, it's gone. The other thing is, depending on how you pay yourself as the business owner, you might have paid yourself all of that $100,000 without thinking about the tax implications of that. So,
well, a lot of people pay through distributions, and of course that doesn't come out as an expense. That just reduces cash.
Like just as they need money, they just transfer it to their personal account. They don't think about like, oh, I need to save some taxes out of this, or it's just like, no, I have a bill to pay. There's $2,000 here. I'll pay it. And, so that's usually like a wide awakening for a lot of people at the end of the year, that first year especially, or the first year that they make money. A lot of times you don't make money your first year or two, so it's not really a big deal. And then, year 3, it's like, oh shoot, what am I going to do now?
Yeah, that was my journey. Was there a specific moment when you realized business owners were misinterpreting their financials, especially their profit and loss statement? I mean, did you see? Was there a specific moment when you went, this is more than a one-off? This is systemic in the industry.
Yeah. Well, so I started having that conversation even before I was a CFO. I genuinely like to help people. So I was always just talking through other friends that were business owners, and we would since I had a background in finance and could kind of help them understand what we were dealing with. They would bring up their profit and loss, and I'm like, does that feel right to you? Like when that net profit or loss at the end of the year, I'm like, does that feel right to you? And a lot of times they couldn't tell me. They would be like, no, that doesn't, that feels too high. That feels too low. One of the two.
That's a great question. Really that is a great question. That helps calibrate your knowledge of their sense of reality, right? Financial reality.
Yeah. Well, because my first step after that, after asking that question, if they tell me no, is to be like, okay, well, first, let's actually look at your bookkeeping, especially if you've been doing it yourself, and make sure that everything is right? Like, is everything accounted for correctly? Because it's possible you've been doing things way wrong, and it is wrong. That's not telling you.
You're either making more than you think or less than you think.
Right. Yes. So that would kind of be my first. It wasn't an immediate, oh, well, this is what it says, then obviously it's right. I was like, well, let's dig a little deeper. But I kept having that conversation over and over again. And people kept saying, no, that doesn't feel right. And sometimes it would be like, well, it's because of all those things we just talked about, the debt payments, the distributions, all of that. I'd be like, if I pull up their statement of cash flows and look at it, and I'm like, no, this is actually pretty much proof that you'd have $0 left over because you spent it on all of these things. But if we would dig a little deeper and it was not seeming right, then it was kind of this, all right, well, we actually need to be fixing the way that you're recording this data and looking at these transactions, because you don't have things entered right, or, we'd make some tweaks and then it would better reflect. Some people are really good at having a pulse on what their business is making, and others are just like flying blind. So learning personalities and all of those things is kind of how as I start working with people more regularly, I get to know what kind of person they are, and, just all kinds of psychology and things like that.
I was going to say, I think a good CFO is at least a part-time therapist. So you can add, in addition to arborist, you're a therapist, maybe sometimes a marriage counselor, all of that, right? Because you're getting in the middle of something that's super sensitive and super important and super scary
I was having a conversation with somebody about, like, money is very emotional.
Yeah,
and
it's charged,
it's
for
just
sure.
it's very much tied. Like, there's a lot of people that have a lot of shame around money, and so they don't want somebody else looking at their finances and having kind of that, like, peek behind the curtains. So other people are the total opposite. They don't want anything to do with their money, and they want somebody else to handle it, and they don't care what it looks like. They're just like, just make it make sense and make me make money is kind of how it works.
Yeah.
So yeah, a lot of it is just kind of learning the personality of the people that I'm working with, how they both can best, like, get information and take in that information to use it. Some of them, I'm like, you need to sell X amount of dollars this week. They will hit that number, and then I do everything on the back end for them, right? Like, I make sure all of it works. I'm just telling them up front, you need to do this in order to get that. So, all of the things that go into it. But
yeah, that's actually, it's like working with a trainer, you give them goals. What were some of the early challenges that you faced building a service-based business centered on trust and financial transparency? I mean, and now you're not serving coffee anymore. You are intimately involved in their finances and to a great degree their success or their failure. I mean, you're witness to it. You're front row. Did you have any challenges pivoting from a retail type establishment to, getting them to talk about stuff they don't like to talk about?
Yeah. So when I owned the coffee shop, I think this is one of the things that kind of goes into this background and being kind of prepping myself to be a business owner, is that when I owned the coffee shop, I ran it. Obviously, I was the owner, but I was never the one that was there. I had a manager, and I was kind of like the, I don't know, puppeteer, like the one that was pulling the strings and making sure that everything worked and whatever. But I was not the one that was like serving coffee every day.
You were working on your business, not in your business.
Exactly. Yeah. And I had a full-time job pretty much the whole time that I worked there, but I worked for this actually kind of plays into why I'm comfortable in the role that I'm in now. I worked for another firm that did exactly this too. I was on the internal team. So I was hiring CFOs. I was doing sales to potential clients. I was managing all of the operations. So I basically got like paid to do what I do now, but like on somebody else's dime, which I am a big fan of. Anytime that you have the opportunity to do that.
Sure.
And being able to learn and see mistakes with somebody else's money is always a great opportunity, especially if you think that you would like to own a business someday. Yeah. But I did that for 3 years. And so I was really able to kind of, when I came into this business, I understood it so well because I'd been doing it for a couple of years already. And so I was kind of, and they were They were a much bigger company, but we scaled from like 3 million to 10 million while I was there, and then had a PE acquisition. And then I think since in the last 6 months since I've left, they've scaled from like, I don't know, 20 million to 40 million or something. They've made a bunch of acquisitions too. So it was really cool to be a part of and kind of see, like I was on a future timeline, right? Like I can see what can happen in my future now just by pulling the right strings.
As your firm grew, did your role shift from doing the actual work to leading the business, or are you doing both? Are you, if this were a coffee shop, are you serving coffee and buying coffee at the same time, or?
Yeah. Currently, yeah, I still have clients. So now in this business, I have clients that I am their CFO. And a lot of these clients are ones that I've had like long-standing relationships with, or they're very local to me or something like that. But yeah, I do have other CFOs on my team. So new clients tend to go to them. We have all of our systems and processes built out so that each client, no matter what CFO they have, they're getting the same sort of reports and processes that are being, given to them. So we can keep a pulse. And if something should happen, like somebody, goes on vacation for 6 weeks or something like that, like somebody could step in fairly easily and be able to pick up and offer the same.
Yeah.
Exactly.
Yeah, that's great. You've said that the profit and loss statement can be lying to business owners. I love that term. I lied to myself many times, so I actually feel a little better knowing it may have been lying to me rather than me lying about what I saw. What does that mean in practical terms, that the profit and loss statement could be lying to you?
That is kind of what we talked about a few minutes ago, is kind of my term when I'm describing this, right? Like when I'm telling somebody, oh, look at your profit and loss, and they tell me whatever number is on the bottom line. Let's say it's 50,000. And I'm like, well, it's lying to you. You don't have that much money. That's profit. In the way that we tend to think about profit, in the psychology way of how people normally think about it. Because there's so many, like we talked about, like debt payments, owner distributions, things like that are like, that could potentially be chipping away at that profit. But the same thing for a loss. That could be like your business could show you a loss, but you feel like there's money in the bank.
Sure.
And that we kind of talked about that a little bit ago, where it's like, let's say that you need cash. And so you run a sale, and your sale, you're actually losing money on your sale, but it's bringing in cash for you to pay your bills. And you might, like, that can go on for a long time. And there's all of these.
That's that Ponzi scheme that we were talking about.
Exactly. Right? It's that Ponzi scheme where it's like, you feel like you're okay. And then all of a sudden, the hammer's going to come down. Something is going to happen where you suddenly cannot make a payment. Or like your example earlier about getting a deposit on a job, but then you use that deposit money to go do other things or to pay for the job that you're currently doing, and you don't set any money aside. But then when you go to do that job, you don't have any money to be able to buy the supplies that you need or to pay your people until you get that second half. So it becomes this like, and that is usually what then triggers needing to do something on a sale to get more money coming in. And it's like, once you start, it's a snowball effect, right? Because it might start off as a little bit of a problem, but the more that you add to it, where you're making decisions and doing things that are not adding profit to your bottom line, that it's like suddenly you're going to be faced with a problem that you can't fix. Yeah. And that's usually, bankruptcy, or you're going to have to start selling assets just to pay bills.
Sure.
Those are all the things that kind of come up. But yeah, a lot of people they'll look and be like, well, I have money in the bank. Why does it show a loss? And I'm like, oh, we are about to have a really tough conversation.
I've also had an experience, to your point, of, cash is good, therefore profit must be good. One thing that can be an indicator that there's trouble ahead is a sudden and maybe even unexpected accumulation of cash. And that happened to us many, many years ago when sales started dropping off dramatically. We were no longer buying inventory at the same levels. Our costs went down because we were not investing in the next months of production. And that gave us a false sense of security because more cash was coming in than was going out. The problem was once that cash got all allocated and we used it, there was a big void in the pipeline for money to start coming back in and making its way through the system. The pipe was not primed anymore. And, we had to pull a vacuum. We had to wait, however many days, 60, 80, 90 days for cash to actually start flowing again. And at that point, we were starved and we were behind the eight ball and we lost that equilibrium. We lost what I like to call a matching principle. I don't know if that's an accounting term or not. It's certainly a Mike term, where I like to make sure that the money we bring in and the money we spend are in the same period, right? Within 30 days of each other, or at least put it in my head so that this money that's coming in on a deposit is not today's money. This money is going to be allocated and match where the expenses are, So that's one reason we don't accept exaggerated payment terms. We believe in keeping everything within, it's kind of arbitrary, but within a 30-day time period, because we can manage cash flow over 30-day time periods. When we're investing money today for something we're not going to get paid for 5 months, it's too hard for my simple brain to reserve that amount of money in my bank account, not to spend it, knowing that that's going to have to pay for something we're not going to, we're not going to get paid for 5 months, or 6 months or whatever it is. There's a number. I think viewing cash flow alone or cash accumulation alone is half the explanation, right? It's almost as counterintuitive as if you're standing on a beach and suddenly the water retracts into the ocean. That's a sign of a tsunami coming, right? That's one of the warning signs of a tsunami. And it's counterintuitive because the water's moving away from me. But it moves away from you before it buries you. And I think in terms of cash flow, a sudden accumulation of cash could be almost the equivalent of the water receding by the ocean. Something traumatic is about to happen. You talk about, speaking of cash flow, cash flow a lot. Why is cash flow often a better indicator of business health than profitability alone? Now, that kind of sounds counterintuitive to what we were just talking about, but I believe I read or I heard you talk about looking at cash flow indicators as a very important key factor, a KPI. Explain why.
So when I'm working with a client, we always develop a 13-week rolling cash flow projection. And that way I'm using it to be able to pinpoint, like with the current cash that's on hand and the expectation of when you should be receiving cash in the future, how long can you actually continue to operate? And one of the things, kind of to what your point you were just talking about, I have clients a lot of times, and this seems like a really great thing to happen, and it often becomes like handcuffs to them because they will have an incredible month. Maybe they do double of what they normally do. And so they have all of this cash come in, but they are on 30 days or 60 days with their vendors. So they had all of this money come in. They were able to not really have any bills that were due from that. And then 30, 60 days later, their invoices are due from their vendors, right? So then all of that money that they made in September, they now have to pay in November.
Yeah.
And usually that money is gone, or it hasn't been saved, it hasn't been allocated in a way.
That's why I like to keep everything within a compact 30-day period.
Yes, yeah.
Because I know me.
It-
I will find a use for it. It's burning a hole.
exactly. And so what happens though is it becomes, I had this happen with one client in particular I'm thinking of, over the summer. He had this 1 week that he had $50,000 worth of AP that was due. $50,000 is nowhere near his average week of sales. And so, but I pushed it. I'm like, well, you have this due. I need you to bring in $50,000 this week. And he did it. But you know what that caused? 30 days later, he had to have another $50,000 a week because he sold 50,000. It became this constant, like, you have to have record numbers every single week or month or whatever to be able to pay what you now owe. And if you're not running that with a profit in mind, profit margin in mind, you're never going to have enough money that's carried over. And so it's just going to be this constant, like, you have to be selling at this really high level in order to be able to keep up with the cash flow needs. And so that's cash flow, the 13-week production. Like, most business owners don't care to look at it on a 13-week period. Like, that's so far out. They're like, I don't care what happens in 3 months. But if I can tell them, okay, with the cash that you have in the bank now, you're going to run out at the end of next week, then suddenly that becomes
Invite you to a party.
Okay.
Yeah. Talk about a buzzkill. But those are inconvenient truths because they're going to run out whether you tell them that or not, right? So they might as well prepare for it.
And I have found that business owners, they are very, they will get it done, right? Another example that I had earlier this year, I was talking to a client. I had just started working with them. And so this was a really tough conversation to have at first because they were like, it was a rough start to the engagement. We'll just say that. They didn't have enough money to run payroll the next week, and they had no jobs in their pipeline. And so as we started kind of doing the math, we were looking at their pipeline. We were looking at how long they were a business that needed permits and all kinds of things in order to be able to do the job.
Yeah.
And so it wasn't always just a matter of, I can go out and sell today, we can install it tomorrow, and we get our cash. It was like a 2 to 4 week pipeline that they needed minimum in order to be able to kind of keep the cash rolling at any given time. And so I'm working through their pipeline and asking them these questions like, all right, well, if we get a sale today, how long does the permit process take, all of that. And that's when we determined, I was like, everything that's in your pipeline, you can't install for another 4 weeks. So it does not matter at this point. From now until 4 weeks from now, you have nothing that's going to come in, and you have $70,000 worth of payroll next week. So what are we going to do? And I was like, you are in a position where you might need to lay off your people tomorrow. Sure. Like, we're in that kind of position. And luckily, the immediate reaction was kind of anger towards me that I was bringing this up.
Shoot the messenger. Yeah.
Exactly. But in the long run, literally the next day they came in and they're like, all right, we need to figure out, like, what counties and towns can we install with no permit? Like, it made them get creative in how they needed to bring in money and where they needed to focus their time so that they could fill those gaps between now and 4 weeks from now. So that's kind of an exercise that I'll work with people a lot of times, because a lot of business owners operate on very slim cash margins. Like, whatever's in the bank today is what, it's like every day they have to be selling in order to be able to pay their bills.
Yeah.
And so if that's you, know that you're not alone, but there is definitely a better way to do it. So
you describe clean books as the foundation for scaling correctly. What happens when a business tries to grow without that foundation? And describe what your definition of clean books is.
So I'll give you an example of yesterday. I was actually working on a client's book. I just started working with them about a month ago, and they had been doing their own bookkeeping. And on the surface, it actually looked like everything was right. Banks reconciled. It was kind of just generally like some of the kind of key things that I look for had been done. But then when I started, this is a big difference, like if you're on cash versus accrual, or if you track your AP and AR. Because if you're using something like QuickBooks on a cash basis, it's very easy for the average person to be able to use it. On an accrual basis, it is very easy to screw everything up.
Yeah.
And so we were looking at, so first work through the books, it was like, okay, this isn't bad. But then I started pulling like AP reports. It was showing all kinds of negative numbers in the AP. And if you've ever pulled a report, that should not be negative.
Right.
And then there was a lot of things on there that where I was like, I don't think they owe this. So there was just some things that weren't right. And then when I went to their AR, there was also just all kinds of random invoices in there that I knew weren't actually AR. So as I started,
was that their way of reconcile? Was that their way of making things balance, just by creating an invoice to?
Well, so what would happen is that they would make a payment. They wouldn't enter the bill into accounts payable. They would make a payment though, and they would code it to accounts payable.
Got it.
And so it reconciled on the bank statement.
Yeah.
That was fine because it came in and out of the bank. It had a category that it was matched to. But the problem was on the AP statement, if you put something on AP, it's going to put it in that bucket.
Yeah.
So that's how we were getting all of the negative numbers.
Yeah.
So I was like, okay, we need to undo a bunch of work, rematch things, and kind of put them together. Anyway, so all of that to say, on a cash basis, if you're doing all of those things, your banks, your statements, your reports might look right, but it's going to long-term be really difficult to kind of unravel all of those things if they go on for a really long time. And the thing about that is, like, let's say that you want to, like, how much do I owe people? What are my outstanding bills? If you pull an AP statement and it has some bills on there that are correct, but then it has a bunch of negatives, the number that you're actually looking at is going to be way off because it's not correct. So that's just one example of kind of how you can very easily mess things up in QuickBooks by only using like the bank feeds part of it and just matching things. Having an accountant, a CPA, a CFO, somebody just that's reviewing things, especially if you're doing it yourself, is, a nice thing to have.
Yeah, for sure. How can business owners uncover hidden profit in their numbers, and what does that process actually look like?
This is one of my favorite things to do because I love looking at profit and loss statements. But one of the things that I will find as I look at a profit and loss, I'll pull a year at a time. I'll organize it by month, or you can display it by month so that you get the totals, but then you get the breakdowns each month. And so I'll just start looking for things that are like standing out to me. Like, why are your COGS so high in this month, but not in any other month? And one thing that I actually encourage business owners to do, because you can tell a lot from your numbers, but there's some things that it's just nice to have records of. And so it's almost like a journal is kind of how I think about it. Like, at the end of a month, kind of, did you run a sale? Did you have a big job that paid a deposit? Like, you kind of keep track of anything that's outside of the norm. So like 6 months from now, you might remember, but in 2 years, if you're looking at your historical data, it's like, why was that month so good? And then all the other months sucked. Or, kind of having some sort of running commentary about what's happening in your business is really helpful as you're trying to tell that story from the numbers. So you can keep it wherever. You can put it in a Google Doc, just some, notes about what happened that month. But that actually helps you uncover some of that hidden profit, because those can be things that you can be like, okay, well, if that worked that month, why are we not continuing to do that? Or just look at your expenses on a month-to-month basis, like subscriptions. That's the very first thing I tell people. I'm like, look at
That's a
your
death by
softwares
a
and
thousand
subscriptions.
cuts process.
Exactly. Because it's so easy. They make it so easy. What's $10?
Yeah,
Except then you do $10 times 100 different subscriptions, and
yeah.
suddenly you're, paying $1,000 extra a month for stuff that you don't need.
You said you love to look at P&Ls. I love to look at chart of accounts. And
Mm-hmm.
I remember once we were like, okay, we're doing everything we can to increase revenue. What can we do to cut costs? And instead of just looking at our total cost of goods sold and other expenses, I went through the chart of accounts. Each chart of account, we have hundreds of them, and
Mm-hmm.
looked at entertainment, whatever, and I'm like, oh my God, it's subscriptions and all these things. And when you start looking at when you break it down into categories,
Mm-hmm.
it was so easy. I think we cut our most of our chart of account expenses, other than components, cost of components and labor, and things like that,
Mm-hmm.
probably by 30 or 40%,
Mm-hmm.
because we didn't realize how out of control it was because they were all relatively small amounts.
Mm-hmm.
But when we looked at it cumulatively, it was great. So I went over it the first time. I cut tens of thousands of dollars out of annual expenses by identifying exactly what can be cut and what we could live without. And then I went through it maybe about a month later again and found another maybe 8 to 10%. And
Yeah.
and then at some point it wasn't worth doing that review on a regular basis. It's like you go for a haircut, you don't need another haircut for another 6 weeks or whatever.
Mm-hmm.
But it was amazing what we find when we look. And
Mm-hmm.
sometimes looking a little bit more granular is more eye-opening than looking at,
Yeah.
from a 30,000-foot view. I mean, both
I'm
are
a big
important.
fan. Yeah, I'm a big fan of sub accounts in your chart of accounts too. So like things like advertising expenses. Don't just lump everything
Yeah,
into advertising and marketing, right? Like make a sub account for your social media ads or your
yeah,
Google ads. If you have contract labor that's doing your posting, like there's all these things that you can kind of break it down to so that you can looking at things on a percentage of your income. You can start to see, uh, have these KPIs in mind. Like, let's say that you want to spend 5% on marketing each year. You can really quickly identify where your marketing is going when you have these sub accounts. You're looking at them on a percentage basis. If something suddenly jumps one way or the other, it's like really easy to pick that out. So there's just like looking at your numbers regularly, at least on a monthly basis, and looking at them like compared to other time periods. You want to look at months compared to previous months, so that you can start to pick these things out. And to your point, like being able to do this regularly and like going in with the eye of what is actually not necessary that I'm
right.
spending money on, you would be very surprised at how quickly you can start to slash cut costs
Yeah, yeah,
when you need
absolutely.
to.
It was like shooting fish in a barrel once I was looking at it. At least the first
Mhm.
pass was. What would your advice be to someone who's considering buying a coffee shop or a landscape business or something? It doesn't have to
Mhm.
be blue collar, but someone considering starting a business. What do you think are a couple of important bullet points that they should really be aware of before
Mhm.
making that commitment?
So first of all, I'm a big fan of buying businesses. That's what I've
Hmm.
done multiple times now, because there is some historical data that you can
Yeah,
already look and see if is it something that people want.
right.
Because starting a business and going all in on a business that you don't even know if there's a market for it is pretty risky. So that's 100% on your own risk, of,
Yeah,
how risk averse you are. But buying a business, I love doing that because you can look at that past history, but you can also, when I'm looking at one, I'm like, if I can't name 5 ways that I'm going to improve it right off the bat, I don't know that it's worth it to me, right? Unless it just happens to be super profitable to begin with, but then you question why would they sell?
Yeah, sure.
So you have to like do a SWOT analysis essentially, but keep in mind what you are yourself are good at, and can you fill whatever hole that business needs?
Yeah, that's perfect. Last question, Jen, because we're about out of time. How did you define success when you first started your entrepreneurial journey, and how do you define it today?
Oh gosh. So when I first bought the first coffee shop, every day, I'd write down my affirmations, we'll call them. And literally from day one, I thought success was owning like multiple coffee shops. And every day I wrote down buy a second location. And I did that. I actually bought one about a year or two after I'd bought the first one. And I very quickly figured out that I was just using that as like my determination of success because like that's what I saw other people saying was successful. So it has to be something that actually is worth it to you. Because I very quickly figured out that having a second location was actually not my dream at all. I was like, this kind of sucks. So when I look at that, I'm like, in my current business, my level of success is like more personal feeling. Like, am I living the life that I want to be able to live and helping the people that I want to help? Like, am I checking these boxes rather than like, oh yeah, I want to have X amount in revenue and, have X amount of clients. Like those are no longer the goal. I mean, they are goals, but they're only related to what that means for me personally. And so that has been my biggest switch in my thinking.
So it sounds like you pivoted from an early definition of success being based upon societal expectations of what success is. So monetary, scale, things like that. That's how Inc. magazine might describe Jen Fizer as the successful, coffee queen or, whatever. And then you made it more personal. I think my first definition was, I know my first definition was, being able to eat, being able to, support my family and make money. Yeah. And now the answer I would give today is a little bit of a cheat answer because it involves all these other things, but it's really freedom. Freedom requires capital, obviously. Freedom requires time. Freedom requires a lot of things. But over the 33 years I've had my company, I've gained freedom, and in a number of ways, as freedom can be interpreted. And to me, that's the best thing. I could work 70 hours in a week. This week is one of those. I could take 3 months off. That's freedom, right? I'm free to work. I'm free not to work, even though I choose to. I'm free not to. And there's something really inspiring about doing something because you want to and you love to versus it's a means to an end, right? So, and I think every person who starts a business, even if they don't start a business, if they are entrepreneurial, even though they're not practicing entrepreneurs, you can be entrepreneurial in a cubicle. I think that the advice you're giving and many of my other guests on this show have given will lead someone to that point of freedom, right? At some point, however they describe that. Jen Fizer, this has been a great conversation. I wish I knew you 33 years ago. I would have obtained my freedom a whole lot sooner if I had. But then again, I wouldn't have all these funny anecdotes. You've heard them all. You've seen all the mistakes.
The story is worth it, though.
The story is worth it. It is about the journey, not so much the destination. It's the journey that really matters, I think. For my viewers who are watching this on YouTube, if you look down here, you'll see information on how to get a hold of Jen through her company. I'll have her company URL there. If you're listening to this on your favorite podcast app, when it's safe to do so, don't do it while you're driving. Look at your podcast app and you can find contact information for Jen as well. Jen Fizer, thank you so much for being my guest, and continued success, whether that is more CFO clients or asking more people if they want sugar in their coffee. Good luck with all of that, and I'll look forward to staying in touch with you and finding out what empire you're building next.
Thank you. Same to you.
Thank you. Well, that's a wrap. Thanks for joining me on this episode of the Reluctant Entrepreneur Podcast. A very special thanks to Jen Fizer for being my guest on the show. We've been very, very busy recording future episodes with fascinating guests, so be sure to subscribe to get notified when new episodes drop. And one personal favor, if you're watching this on YouTube, consider giving us a like and subscribe. Those two very simple clicks really help us expand our reach. If you're an entrepreneur or know someone who would make a great guest, I'd love to hear from you. Visit reluctantentrepreneur.podcast.com to apply or recommend a guest. You can also reach me directly at mike@reluctantentrepreneur.podcast.com. And a real quick shameless plug, if you're interested in my book, The Reluctant Entrepreneur, Anatomy of a Business Startup, From Uncertainty to Unstoppable, it's available in paperback and Kindle on Amazon and as an audiobook on both Audible and Amazon. Thanks again for listening or watching. Until next time, be unstoppable. I'll see you again soon.